Hey, what's up, everybody? Welcome back to Investing Sucks. And today we're doing another installment of the Your Company, My Analysis series. And we're looking at a company that I would say is not very well known, but was pretty highly requested. I've had multiple people over the course of several months ask me about this specific company. So now I'm getting around to it. And the company is Park Lawn Corporation. So it's a $1.1 billion company that's listed on the TSX. And as you can see from the company's description down here, they are actually a funeral home service mainly. They do have plenty other ancillary services that you can see here, but essentially they are in the business of death, to put it morbidly. And this is an industry that will always exist. It's always around, and it's an industry that no one really thinks of entering. I can't imagine there's many kids out there or young adults that have dreams and aspirations of entering this industry. So it's one that doesn't really change a whole lot. We'll look at some of the research that they provided in their filings that point out some trends in the industry, but it is very unique in that regard. And I can't actually think of another publicly traded company that is in this industry. So maybe there is one. If someone knows one, then drop a comment. But as far as I'm concerned, PLC is really the only one. Now, it's important to note that this company is attempting a consolidation strategy. That's really what they're trying to do, consolidate the funeral home service industry, and as well as all the other ancillary services that you can see in the description there. So they've been going on a buying spree of buying other funeral service companies, similar companies, cemeteries, to consolidate the industry. So why are they doing this? Well, let's go to this section and they kind of talk about their growth story a little bit here, or their growth strategy as they call it. So for them, it really has to do with streamlining operations to cut costs. It's not so much about the expansion of the Park Lawn brand, which is sometimes what you would see with a consolidation strategy. It's a pretty simple consolidation play, actually. You take a industry that doesn't really change a whole lot, buy a bunch of companies and streamline operations by centralizing operations and all the different cost centers that company has. And when they make acquisitions, they won't even really, I would assume they won't attach the Park Lawn name and the Park Lawn brand to the company that they're acquiring, because they want to retain the brand equity and the historical value and all that stuff that the place holds in its local community, that wherever it's in. And if they give it a corporate sounding name, then people probably won't use them anymore. So that's pretty much the main way they're going to grow, is inorganically through acquisitions. You're probably not going to see a lot of organic growth in a company like this. Or they could expand their existing locations by remodeling or construction to build out their premises. But that also requires capital. It increases the amount of space that they can sell. But I mean, that's mainly it in terms of how they can grow. So you're not going to see explosive organic growth in a business like this. There's just no way that could possibly happen. So they need to spend cash in order to grow, whether that's growth capital to make the premises bigger, or if it's through an acquisition. So later when we do the DCF valuation, which I'll get into kind of in the second half of the video, you'll see how I factored that in. I had to do a bit of reverse engineering to make it work, but you'll see what I mean when I get there. Now, the other thing I wanted to point out is if we scroll up here, we can see in this section here, so they mentioned something interesting here. Cemetery services can be purchased on an at-need or pre-need basis, pre-need contracts, so contracts they sign when the person is still alive, essentially, are 65% of their cemetery business. So it's kind of these fixed price agreements, as they call it. So that's another unique aspect of the business, specifically their cemetery revenue. 65% is actually pre-sales. So customers purchase the services in advance, which from a working capital perspective, getting paid in advance is great because you get paid before you perform the service. And it means the business is essentially self-funding. There's no need for them to set cash aside to purchase inventory before they can sell it, or other assets they may need to perform the service. They are required by law, as we'll see later when we look at the financials, to take some of that money and kind of hold it in trust. But from a working capital perspective, getting paid before you actually do the work or perform the service is a great thing, because you have that money in advance and you can use it, like I said, to buy whatever it is you need to perform the service. And you don't really, if you compare it to, say, a retail business, the first thing you need to do in a retail business is actually get inventory, which you need money to do that. So if you imagine in a retail business, imagine if you got paid before you had to go out and buy the inventory, right? You wouldn't need to raise capital in order to buy the inventory first and then sell it. So it's a very unique business in that regard. So as we can see kind of in this graph here that breaks down their revenue and where their revenue comes from, we can see that they actually generate some some interest income, so interest revenue from the cash that they're holding in trust. So they invest in very low risk assets, as they should, that earn interest, and it's some extra money for them, which is, again, it's a very unique part of the business because they get paid sometimes many, many years in advance. They hold that money in trust and they can earn some interest revenue on that, which they get to keep. So it's almost like they're getting paid in advance so much that they can then earn the interest revenue on it. Now, if you are someone, for whatever reason, you're interested in learning more about this business, they actually do a very good job, I think, of outlining the trends that are happening in their industry in their annual information form here. And I'm not going to go in depth on all the trends because it's pretty morbid to go into, actually, but at a high level, they did mention that in the US and Canada, which is that's where they operate, these countries have aging populations, and they also mentioned that cremation is becoming increasingly popular due to cultural acceptance, and they detail that here on what I'm showing on screen. And it's actually a trend that's not really in their favor because they mentioned the average revenue they receive from cremations is less than for funerals. So I would say that's a little bit of a risk, that there is that strong industry trend that is not playing in their favor, and it's one that you're likely to see develop more and more into the future. They also mentioned a few other things, like there's some low-cost providers of some larger companies that are kind of getting into this business and providing basically basic services at a lower cost than them. So they're a bit more upscale and upmarket in terms of, this service and what it actually is. So again, if you want to learn more about this, I won't go too in depth, but I would recommend reading this because it gives a lot of detail on that. Okay, so the next thing I want to do quickly is look at valuation metrics. So I pretty much always do this when I'm looking at a company, and the first thing I like to look at is price to sales. Now, some people don't like the price to sales ratio. I personally really like it as a way to bring it, many years back and see how it's kind of evolved for the company, because it reveals some pretty interesting trends about the business and how investors have valued the business over time. Now, the price to sales ratio can change if investors' perceptions of the company's future performance are increasingly positive, or if the company becomes more profitable, because then each dollar of sales is now worth more in terms of cash flow. But this hasn't really fluctuated a whole lot, especially compared to other examples we've seen. If we go back many years to see where they were really 2009, they weren't really a well-known company then. They probably weren't even on the TSX at this point. They had a 1 price to sales ratio, but the average, the mean, is about 3, and it's been higher at some points here. And then currently it seems kind of it's in the middle of where it's been currently. So, I mean, no real crazy insights to draw from there, I don't think. The other metric I like to look at is enterprise value to unlevered free cash flow, because this is more about free cash flow, which they do generate free cash flow, so we can use this metric. It's going to fluctuate a lot depending on some really positive years. So I'll keep it kind of recent here. And currently it sits at 34, which is, that's actually decently high for a company that really doesn't have a whole lot of growth or organic growth potential. So the reason that is high is going to be because of the strategy that they've come out and said we're doing, which is to buy companies, consolidate the industry. So people are going to assume that they're doing that currently. And in a way, I would almost compare them to Constellation Software. If you think about their business model, it's pretty simple. Just use the free cash flow that the software businesses that you own generates. And the software businesses that Constellation owns, a lot of them aren't growing at all. If you actually dig into their financials, you'll realize that a lot of those businesses sometimes even have negative organic growth. But the reason they keep growing, and the reason why they're always going to grow, is because they're using the free cash flow they generate and not just leaving it in their bank doing nothing. They're buying companies which then generate more. So it's this snowball compound effect, which eventually the company gets bigger and bigger. So although this ratio of about 35 does seem high, given what the company's strategy is, it does make sense, because it's similar to Constellation. It's that snowball effect where even if there's no organic growth, they're using their actual acquisitions or the free cash flow they generate to make more acquisitions, which then generates more so they can make more acquisitions. And it's that compound effect that all investors love. Okay, so next, let's take a look at their financial statements, and let's use what we've discussed so far to kind of discuss their financial statements. So we know that they have the goal of consolidating to cut costs. So if they have been doing that successfully, then we should be seeing improving operating margins. So I'll go back to here to actually see what this trend has played out over time. And in the income statement, well, we can see gross margins to start. They have been increasing 54, 55, and have increased to about 73, which is pretty significant. And with operating margins, again, it's kind of the same story. Actually, they've fluctuated quite a lot. But since 2016, we've seen a pretty smooth uptrend here and currently at about 16.7% operating margin. So that strikes me as pretty good. You know, as we said before, they're more upscale, so they're probably going to have higher margins. But next, let's actually take a look at the balance sheet, because they do have a kind of confusing balance sheet, as I'd say, because we can see here they have total assets are almost $1.8 billion, and they have some very large accounts, as we can see here, property, plant, and equipment, because they do own a lot of the premises. But then they have things like this, like the care and maintenance trust fund investments. So there's a few big items that stand out, one of which is that one. And they are required by law to deposit a portion of the money they receive for selling certain things. So that's what that care and maintenance trust fund is. And it's designed to, you know, like you would say, maintain the premises that they have. So it's really, the reason that account is there is because it's a law. They have to abide by it. And so they invest that money, and they use the money that they receive from the investments to cover those maintenance and care expenses. So that's what it's like at its surface. It's a little bit more complicated when you actually drill down and realize that different US states will have different regulations for this, but that's what it is essentially. So another asset account that you can see there is a pre-need merchandise and a service trust fund investments. So what is this? Well, if we scroll down to this page here, which has the note that kind of details what it is, we can get a better understanding. So we mentioned before how they get paid in advance for some of their sales. So again, they're required by law to hold these in a trust until they're actually needed. And they do invest these funds. As you can see, they have all their investments broken down here. So they are actually earning money from the revenue that they've received but haven't recognized yet, because again, they haven't performed the service. So by accounting standards, you can't record that as revenue. You can only record it when you actually perform the service itself. This is a very interesting dynamic, and I would almost compare this to insurance companies with their float. And the reason why investors love float with insurance companies is because it's like free financing, right? The person you're insuring gives you money, and you keep that money unless their policy kicks in which you have to pay them the money. And so basically you've acquired capital for a brief period of time, in the case of insurance companies, essentially for free, because there's no dividend requirements, there's no interest to be paid on it as if it's debt. And it's the same thing with these pre-sale contracts, right? People are giving them money and they get to keep it. It's essentially free money for a brief period of time, and they can invest it and earn additional income off of it. So I would compare it to kind of insurance float in that regard, because it's a pretty similar dynamic. And let's actually look at how this plays out on their income statement, so you can see what I mean. So here's their income statement. You can see their net sales, 350 million last year. This would be from their actual services. And then there's the income from their care and maintenance fund. We talked about what that was. And then 6.6 million in interest income. So you might think, well, I mean, that's about, what is that, $18 million out of $369 million in total revenue. I mean, that's just drops in the bucket. That's really not a whole lot. But keep in mind, this has no costs associated with it, right? I mean, there's probably costs of people, you know, looking at investments and selecting them and managing them, but there's no gross profit on it. You don't have to buy something to then go and sell it and make a margin off of it. It's just, like I said, it's essentially free income that they get to keep. And how much are they actually earning? Well, their net earnings for the year were about $35 million. And we know that 18 million of it basically has no cost. So maybe there is some cost associated with it, but basically half of their profit would be coming from the interest income and the income from the care and maintenance funds that they're generating. So it's a significant part of their business. And what's even more interesting, so about 18 million in income from these things, from their investments, as we could call it, from these pre-sale contracts and whatnot. So 18 million, how much are they paying in dividends? So let's scroll down to statement of changes in shareholders' equity, but we can also see it on the cash flow statement here. So here, dividends and distributions paid is 11.1 million. So they're more than paying for their dividends off of that, generating that interest income and the income from their investments. So it's a big part of how you get paid back as a shareholder of this company. So it is a lot more significant than it may seem at first. Now, obviously, their funeral operations and cemetery, all that is still going to be a big part, but that's kind of the hidden message with this company. It's something I really wanted to get across to you guys taking time out of your day to watch this. Is sometimes with these types of companies, you got to dig a little deeper and say, okay, what this company actually is and how you get paid back as a shareholder may not be as simple as it seems at first. So that was the main point I wanted to say there. So quickly, I also wanted to look at one more thing I wanted to mention in regards to the liability section. So those trust funds that I talked about, so the care and maintenance trust fund here, pre-need merchandise service trust fund investments. So you're going to see an offsetting liability for this. So you can see for this one, 291 million, exact same amount here in liabilities. And then for the other one, 329 million, exact same amount here in liabilities. So that's how trust fund accounting works. It's you hold the money in trust. So it is technically cash that you have on your balance sheet, but you owe it to someone else. So it's an asset and it's a liability. So it doesn't affect your book value at all because it's assets go up, liabilities go up. There's no net change there. And then we can also look at deferred revenue here, 200 million in deferred revenue, which deferred revenue basically being future revenue that you get. So it's your customers that have paid you for a service. You haven't performed the service yet. So it's still technically a liability because you're liable to perform the service in the future under the contract. So 200 million in that. So, which is a significant amount because the company is a $1.1 billion company and 200 million in liabilities from deferred revenue. So let's look at the cash flow from statement of cash flows. So what I wanted to look at is to see how much of their investments or in their acquisitions, they're actually financing from cash from operations. So they generated 79 million in cash from operations throughout 2021, and they paid 150 million in acquisitions. So they're not covering their acquisitions with cash from operations. They have to cover it through other means. And how are they doing that? Well, they're probably going to be issuing shares. So we can see here a pretty large share issuance here, pretty significant one, $141 million. So maybe in the future, they'll get to a point where they're generating enough cash from their operating activities to cover their acquisitions. But at least for now, you would expect to see some dilution there because in order to continue their growth strategy, they got to issue more capital, which it isn't necessarily going to be a bad thing because if those acquisitions they make end up creating more shareholder value for the company overall, then it is absolutely a smart move. But next, I want to go into the DCF valuation to show you what I did there. And this will probably kind of make the concept I just said there probably will make more sense once I do that. Right, so here is the DCF valuation right here. So I'm not going to go through every single assumption that I made in here because it would take too long. I want to stick to the more high level concepts. But I'll kind of run through the basic ones. So I have revenue growing at 20% a year. And this is somewhat of an estimate, but kind of a reasonable estimate. And then EBIT margin is growing at 16.5%. And then it grows because we did see that it would grow. And they do expect EBIT margin to grow because of the whole consolidation strategy, streamlining operations would make the company more efficient. So if we assume they're successful at that, we would expect the EBIT margin or the operating margin to increase. And then perpetual growth rate is kept at 1%, which is an assumption I use most of the time. Tax rate 22%, and then 8% cost of capital. And the share buyback and dilution rate. So this one I kind of had to engineer, and it's probably the assumption that deserves the most attention. So I'm assuming that their shares are going to grow at about 9.5% a year, which is pretty significant. So how did I get to that? Well, we know that their sales aren't really going to increase organically. So the main way that their sales are going to increase is by making acquisitions or by growth capital, right? Expanding their premises. So basically this here is the difference between what their revenue will be, what I'm projecting kind of throughout 2022 and then all the way to 2028, which is significant revenue growth, right? This is very growth dependent. And the way they're going to achieve that is through their acquisitions, which they may have to issue shares towards. So I said, okay, this is how much the revenue is going to increase by. How much do they need to spend on acquisitions in order to achieve that? Well, if we assume that the average price to sales ratio of the companies they acquire is 3, which based on what we saw before looking at the price to sales ratio, 3 seemed about what it was for Park Lawn. So we'll use that as our assumption. They need to make about $2.6 billion in total acquisitions throughout this time period to achieve 20% growth in sales each year, right? That's kind of what I'm saying here. Now, as a rough estimate, let's assume that 1.2 billion of that gets financed through their operations, and about 300 million of that gets financed from issuing debt. So the remainder is going to have to be financed through issuing shares. So this is how much they're going to have to issue in shares, the total amount of funding in order to achieve that amount of acquisitions. Now, if we assume they have an average share price of $40, so it's currently at about 33. So throughout the 7.5 years that I'm projecting here, I'm basically saying the average share price will be $40, which might be more on the conservative side, but let's assume it's $40. Then if we take this number divided by 40, we get 27 million, which is how many shares they need to issue in order to achieve this level of acquisitions. So the 2.6 billion. Now, their shares outstanding as of their 2021 year end was 31 million, which means at the end of this model here in 2028, they will need 31 plus that number there, which is about 58.5 million shares outstanding. And then I basically just engineered this number so that it equals this. So if I go back down to the model, we can see their shares outstanding kind of at the end year. So 2028 is the number I have here, 58,480 million. So all the other assumptions, again, I'll attach this spreadsheet in the description of this video if you want to drill down to everything that I did. But basically this gives us an estimated return of about 10%. So I try and aim for 15%. So 10% doesn't really interest me personally, but it does seem like it's a solid return, right? It's definitely not a negative return. And I would expect, based on what I can see about this company, that you'd probably do okay, right? It's a fairly low risk business. And as long as management can continue to find good acquisition targets and basically just keep doing that, then, you're probably going to do okay on this investment. Right, the business is very predictable, so it's unlikely there's going to be much disagreement or confusion in the general investor community about what the future performance of a company like this look like. And I'm basically assuming that most, if not all of their growth will come from acquisitions or capital expenditures to expand their premises. So in conclusion, I think at their current price that you can buy them on the market today, you would probably do all right with this company long-term, maybe match the market or slightly outperform. It doesn't appear to be vastly mispriced by any means, and it really strikes me as a safe investment, the type of investments that a lot of Canadians seem to like. I personally won't be buying it right now because there doesn't seem to be anything that leads me to believe it's a screaming buy, just one that is probably going to be decent. And again, this is my personal opinion, you don't have to follow what I'm saying exactly, but my portfolio strategy is one where I like to be highly concentrated in really high conviction companies. So for me, it's going to be a pass, but overall, nothing strikes me as horrible or potentially concerning about this company. So anyways, guys, I hope you did enjoy this video. If you did, leave a like. And if you like this type of content, then make sure you hit the subscribe button, and I'll see you guys in the next video.